Hello, this is Ed Butowski. Welcome to Wealth Transparency, our very famous podcast with Andrew Tang with Turner Financial Group and Michelle Connell with Portia Capital Management. I'm thrilled that both of you are here. And what we do on this podcast is we talk about headlines that are not that well known or storylines that are not that well publicized. And we try to discuss what you should do with your portfolio as a result of these headlines. So one of them is oil. We're all talking about oil and the supply shock, but a lot of people think that the shock was worse than what people had forecasted. OPEC output dropped 27% in a single month. Andrew, why don't you take us on what the implications of that is?
Sure, would love to. As you have graciously pointed out in the previous podcast, that you can't believe that the daily global demand or usage of oil is over 100 million barrels, right? That's really crazy. So from that angle, we have to also take a look at, well, what's OPEC's portion of that? So when I dig a little deeper, 27%, that it's only equal to roughly about 7% of global supply. So we also know that due to uh, the Strait of Hormuz blockage and the oil supply disruption, the existing oil producers, they are increasing capacity. So we know that. Saudi Arabia is probably the biggest player that has the capacity. They can most likely increase about 1.5 to 3 million barrels per day if they can. Kuwait, Iraq, the US, Canada, South America, Brazil, Argentina, all the way to Africa. They're all increasing supply. So I think this scare, it's just headline grabbing. And the reality is that it is not as bad as most people think. That, to your point, you're correct, that this is just a psychological headline item. In reality, the supply is doing a lot to try to catch up as well.
So, Michelle, to be very specific, what does this do to the investment market? Because we do know the supply constraints last a lot longer than raises. So, what does this do to the stock market?
Well, I feel like we're in a push me, pull you environment between what's going on with energy versus what's going on with the build out of AI. We're continuing to have inflation pressure from energy and LNG and fertilizer, but at the same time, we have a good growth machine that's helping us out. And I think the focus has been until recently, the last couple of days, on the growth side. So we're discounting what's going on in the Middle East to a large degree and focusing more on the growth quotient. And earnings have been really good. And EPS estimates for the S&P stayed strong for this year, and for next year they're like in the 15 to 17% range. So I think investors are thinking, you know what, this is something that's short term. I'm going to look at it, in context.
So, along with things being looked at in context, we have to look at the global growth rate that the IMF has put out. It's down from 3.4% to 3.1%. So, Andrew, this sets up perfectly for stagflation in the world.
Yeah, it's a really good point. This downgrade, it's not exactly a sign of recession. It is slowing growth, but it is, if I can pull up the chart here, and you'll be able to see that it is not spread across evenly. There are some countries that are having a smaller output and smaller piece of a pie, and their contribution to global growth and their participation rate, it's different. But at the same time, we can also see that like India, it's growing gangbusters at about 6%. China is still expected to grow about 5%. So US, we see that underneath that GDP number, what's really slowing us down is the infrastructure building. So in the larger capital intensive projects, we are having a setback in that. Other than that, obviously 70% of our economy is still based on consumer, and the consumers are still spending. And so from that regard, this particular downgrade, I don't think it's going to be too much of a shock to the system. And I don't believe that we're having stagflation by all means.
Well, you bring up some very good points, Andrew. Michelle, Why don't you touch on your view about are we in stagflation or not? And I'm sure that we're not in a recession in the United States, but I don't think we're in a global recession either. But also, what kind of impact does the oil issue have on this number?
I think it depends on what income group you're in, right? I mean, in general, I'm seeing estimates. I think this is probably an overestimate, but that in the United States, the average family is now paying $400 more in their monthly budget. I think the majority of what we're being hit on is gas and travel, somewhat on our food. But you have 60% of the consumer spending in the United States is the upper 10%. In my research, I found that out, and that they're doing just fine. I mean, Delta's CEO came out and said they can't sell, or they can't keep up with demand for the upper tier travel because they've raised their airfares. International airfares are up for like 25%. People are still buying. And on that point, airlines have been absorbing the energy costs, but that may not continue going forward. But the upper end consumers are just flush with money. And so, for instance, if you have $1 million portfolio, and if you're doing on average, let's say this year, you've made $30,000, okay, or more. So you see that, and it makes you feel wealthier, and you're going to want to get back on that plane and pay five to $8,000 for business class or more to have that experience. I think we just have so many wealthy people here that 60% of our consumer spending, that's a lot.
Yeah, and you look at retail sales in the month of March reached a high, which blew everyone away. Even with higher gas prices, you still had very high retail sales, which then kind of brings me naturally to consumer sentiment hit extreme lows. So there's a huge difference between consumer sentiment and investor sentiment. Andrew, why don't you take us on that one?
Yeah, it's pretty evident that we're seeing the divergence between the haves and have-nots. So this Cape-shaped economy continuing to play out as most people contributing to the consumer sentiment low number around 47, which is the all-time low. It's really is a reflection of their insecurity of their jobs. They don't know when they're going to be fired. They don't know when AI is going to replace them. And when you don't have that security, you're going to feel very insecure. And that's why this consumer sentiment number is low. But on the flip side of this is that when I look deeper into the spending data. So I look at Visa and I look at American Express. Their spending actually increased 10% and 20%. And then when I also look at consumer consumption, like retail sales, like you said, they're all actually up. And underneath that, you see a lot of computer equipment and many other goods that they are tech related as well. So I understand where that's coming from as well. But traveling, it is still red hot. You have revenge traveling and you have people just across the board from all income levels are traveling. The divergence between sentiment and actual spending, it is still completely out of whack right now. And so I don't think we can do much about the consumer sentiment number or the data. It's just a reflection of the psychology versus what really goes on in the real world.
Andrew, I have to ask you, you said something about revenge sentiment.
Revenge traveling.
Revenge traveling. What is revenge traveling?
Revenge traveling is that when people were all cooped up at home at COVID times, when there was a global shutdown and people were forced to be stuck with their loved ones 24 hours a day in their tiny apartments, time to get out. And that's revenge traveling. It's a term that I didn't make up, but just conveniently used.
So, Michelle, when you compare investor sentiment to consumer sentiment, what is your takeaway from comparing both of those?
Well, the consumer side is much more emotional in general. The saying goes, when times are bad, Americans will spend. When times are good, Americans will spend. I think there's some truth to that, whether it's taking yourself out to a restaurant because you don't feel well, or as Andrew was talking about, traveling. And by the way, traveling has not declined at all since the end of COVID. Desire, it just seems to be increasing. And that's very different than investors. And I think when this entire period that we've had since the war, I've had people saying, they're really surprised at how the stock market has stuck in there. But I think we've seen that we've had so many shocks since COVID. We had COVID, we had Ukraine, then we had that financial crisis. I can't remember the bank, if you could call it that. And now we have Iran, Iran. So I think we're just almost desensitized to those. And we think the stock market's going to continue to do well over time, which it does. And so until we really get something that's going to sideswipe us, I don't think the investor, institutional or retail, are going to sit on the sidelines. I don't. I think they're just going to keep saying, this is where I know I can make money, steadily over time. And they're just not, unless they're really emotional, and most investors aren't, they're going to hang in there and they're going to stay invested.
So this is a subject that drives me crazy, and that has to do with climate change. And it drives me out of my mind to think that individuals have an impact on the climate. But that's a whole other discussion. But what I'd like to focus on is there a shift in how people are investing today away from the climate focus? Andrew?
Absolutely. This is a very hot topic, and I'll keep it short. I'll try to speak as fast as I possibly can. Now, if we go back in time, okay, I don't want to even go there, but let's just say, how did this thing start? Okay, I can go all the way back to Bill Gates, in his letter to the investors, basically saying that there was a doomsday view of climate change. And then he also said that unfortunately, all of us, this view is wrong. So he openly admitted that we don't have a doomsday scenario, and people are going to live and thrive in most places on earth in the foreseeable future. They're just going to be fine. So this goes hand in hand with the World Bank's Climate Change Action Plan Act, based in 2021 to 2025. If you can believe it, there's close to $100 billion that is allocated to these efforts. I wouldn't exactly say that these ROIs are negative or return on investments is negative, but there are different priorities that are more important. And that's what made IMF the decision, because at the end of the day, there are votes that happens behind the scenes. So the Treasury sets the policy, for example, for the USI, and the executive director votes it, and then Congress influences these decisions. And so all these, basically that act is expired, and the current administration just basically said, hey, let it expire because we have different priorities to deal with. For one, we have to prioritize to secure the energy level. We're not producing enough, for example, for this AI build out. And then secondly, we just have to deal with inflation. But the cost of items are more important. And so this initiative, it's shifting from climate focus to different policies, to basically to help improve the lifestyle of people generally around the world. I'll stop it here.
Okay. Michelle, why don't you pick up and give us your view? Do you see investors shifting from climate focused stocks more over to energy, infrastructure, and geopolitical alignment?
I think the phrases that I found when I was looking at IMF and the World Bank are they want geopolitical stability, meaning that they want stable prices, and they want areas like Africa, et cetera, that are having difficulties with food insecurity. They want to help with that. That's why they've backed away from the green initiative. At the same time, they still do want energy independence, because that's an issue that we're finding ourselves, not us in the United States, but look at the problems that Europe is having, how much their growth numbers are being pulled back because they're being held hostage first by Russia and now by what's going on in the Middle East, because they don't have the fuels and the fertilizers that they need. So I think maybe less green. You're seeing an emphasis, and the data centers are helping with that. Nuclear, I don't think that's going to go away. I think we need to be able to build that out so that we can, on a cost-effective basis, supply energy to the data centers without hurting consumers. So I think there are going to be areas that provide that energy independence versus, just chasing something like wind, et cetera, that, as Andrew said, there's no positive ROI unless you have like tax incentives. So we're going to focus on things that are positive in terms of return, like nuclear.
I mean, that's ultimately what we're all paid to do, is to find ways to make money for our clients, not just
Exactly.
some, you know,
Yeah.
goodwill mission.
Exactly.
So I want to finish with talking about the overall markets. They're being led by tech right now. Andrew, do you think that that's going to continue?
I have to say, with bias, yes. With bias, yes. Continuing echoing what Michelle was saying, is that the market climbs a wall of worries. We throw anything at it, the market has been time tested, and it is driven with a very strong undercurrent of many innovations platforms converging at once. So this is the undercurrent that people don't talk about. They only talk about what's on the surface. But the undercurrent growing is so strong, it is more powerful than as if you're building the internet all over again back in 1999. This AI didn't come from this really came from big data. Until you have the chips that have the ability to compute, the big data is no use. And now, because you have to compute, now the big data became AI. Now AI can generate synthetic data. Synthetic data trained becomes synthetic intelligence, and so on and so forth. So this is a hockey stick that is going parabolic, and the entire world is lifted in terms of our ability to solve problems. And so it is a strong undercurrent. It is such a strong scenario, and tech is leading the way. And I know it's expensive right now because we're still using the existing method of looking at the market. But this monumental change behind the scenes is so much bigger than what people understand right now. We have to really be a little bit more forward thinking, be cautiously optimistic, but cautiously optimistic, because we still have to deal with the short term volatility. But bar none, tech is the leading sector that, in my view, will generate the most wealth. And it will lift all the other sectors, because when AI solves the problem, for example, in biotech, when money is going to be more affordable, when cost of capital becomes sensible again, then NA activities will continue, deregulations, increase in investments, and all that will return back to the investors.
So
Strongly believe that.
I take that you're a raging bull.
Yes, I guess.
Yeah,
Yes.
which is a great thing to be. And
Yeah.
Michelle, you take the tech stocks and put them aside. What's another sector that you see starting to gain ground?
I think people are starting to look at healthcare because we have an aging population globally, except if you push out to Africa, which has a very young population. And AI is going to start helping solve a lot of these problems combined with biotech. So I think there's going to be some higher interest in that particular area where technology is combined with healthcare and things like even medical devices. I invested in a company a couple of years ago that has an AI chip that they put into an portable ultrasound, and you can take it anywhere versus using something in a hospital setting. There's a couple companies that have done this, and you're able to diagnose things out in the field in third world countries that you haven't been in the past. So that's a device that is utilizing an AI chip inside. You're going to continue to see things like that. Like Andrew, probably because of my background as a semiconductor analyst in a prior life, I love tech. Tech is growing double the rate of the underlying economy. And so I think anything that's innovation oriented, that's how you're going to double your wealth over time at a quicker pace than an underlying S&P index.
Well, this has been a terrific conversation. I appreciate both of you, Andrew Tang with Turner Financial Group and Michelle Connell with Portia Capital Management. Michelle is out of Fort Worth, and Andrew, Jersey, would I say?
New York, New Jersey.
New York, New Jersey.
Yeah.
And I encourage all of you who are watching, not only should you subscribe so you get this each week, but also pass this along to your friends. And if you need any help with your finances, reach out to Andrew or Michelle. They're excellent people and very, very knowledgeable. So thank you very much for joining us with Wealth Transparency.
Thanks for
Thanks,
having me.
Ed.